A very warm welcome to all the participants on this call. On the call, I am joined by Mr. Ashim Jailam, our CEO, and our Investor Relations Advisors, SGA. I hope that you have seen our results and our investor presentations by now. The presentation is also uploaded on the stock exchange as well as at the company's website for reference. Before touching upon company's financials, I would like to provide an overview of some key highlights in the industry. Buoyed by surge in domestic demand, the automobile component industry is poised to undergo a resilient upswing in revenue throughout the fiscal year 2024. This surge is emphasized by the notable trend of vehicle premiumization, focus on local manufacturing, and strides in enhancing exports and regulatory standards. Suppliers within the automotive component sectors are anticipated to showcase growth over the medium to long-term horizon. The forthcoming fiscal year 2024 is anticipated to witness capital expenditures, primarily channeled towards the introduction of innovative products, the advancement of existing product portfolios tailored for specialized platforms, and the driving force behind the development of cutting-edge technologies and components for electric vehicles. In addition, the industry's growth trajectory is substantiated by a consistent and stable demand for replacements, attributed to increased mobility and upswing in economic activity, and the strong movement of freight. These factors collectively serve as catalysts, propelling the industry's expansion. On the passenger vehicle segment, this segment grew by around 9% year-on-year in Q1 FY24, largely driven by utility vehicle sub-segment growth. The growth can be attributed to a blend of elements, including increased production for high-demand models with substantial order backlogs, enhanced semiconductor supplies, the introduction of fresh models to the market, and a favorable outlook from both customers and the economic standpoint. A favorable monsoon conditions have resulted in increased farm income, leading to notable improvement in rural demand. All these factors have played a pivotal role in continuous expansion of PV sales, solidifying the PV segment's position as a prominent catalyst for growth within the automotive industry. Coming to the commercial vehicle segment, in Q1 FY 2024, there was a 3% decrease in sales compared to the previous year. This decline can be attributed to several fleet operators opting to accelerate their purchases in March 23 due to impending transition to BS6 Phase 2 regulations with an associated price increase. Despite this contraction, the prospects for the commercial vehicle market remain optimistic, with growth trajectory projected to persist. This positivity is underpinned by ongoing infrastructure expansion and sustained economic activity. Furthermore, improved e-commerce and advancements in last-mile connectivity are poised to strengthen the commercial vehicles, supporting their demand moving forward. Two-wheeler segment sales volume increased by 11% in Q1 FY24 compared to Q1 FY23. Although sales figures have not yet fully returned to pre-COVID levels, there are promising indicators of a resurge in rural demand, aided by availability of more accessible financing options, the introduction of new vehicles, particularly in the premium category, and a robust replacement demand. A key catalyst driving recent momentum in electric vehicle segment was the FAME subsidy, which resulted in a substantial surge in consumer purchases during May 2023. With the subsidy taken away, it temporarily impacted the demand for a e-two-wheeler in June 23. Despite this, the overall prospects for the EV two-wheeler segment remain optimistic given the favorable policy measures, technological advancements, and the ongoing introduction of novel models. Having shared my thoughts on the industry, I will now move to operation and financial performance of the company. On the consolidated basis, we registered a revenue growth of rupees 654.1 crores in Q1 FY24, which is a growth of 4.2% as compared to Q1 FY23. Our EBITDA for Q1 FY24 is rupees 68.2 crores as compared to rupees 60.8 crores in Q1 FY23, which is a growth of 12% on a YOY basis. The EBITDA margin for the quarter grew by 75 basis points from 9.7% in Q1 FY23 to 10.4% in Q1 FY24. Our PBT for the quarter was rupees 74.1 crores after accounting for shares in profits in JV and its associates. Our JV reported a profit of rupees 0.28 crores in Q1 FY24 as compared to a profit of rupees 0.52 crores in Q1 FY23. Our PBT grew by 23% compared to Q1 FY23. The PAT for Q1 FY24 was rupees 55.2 crores, which registered a growth of 22% as compared to Q1 FY23. On a full year basis, our revenue, EBITDA and PAT grew by 20%, 24% and 40% to rupees 2,700 crores, rupees 282 crores and rupees 208 crores respectively. On the balance sheet front, we continue to maintain a healthy liquidity position for more than rupees 572 crores in cash and cash equivalents, including investments and bank balances as on 30th June 2023. With this, we can open the floor for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Rahul Agarwal from 9-1 Capital. Please go ahead.
Hi sir, my name is Gaurav. Sir, just a couple of questions. One is on this latest SUV from Honda. Are we present in that model?
Hello, I cannot hear you clearly. If you can just repeat the question, please.
So there is a new SUV which is getting launched in the month of September from Honda. The model name is Elevator. So are we present in that particular model?
Okay, so we do not give customer or model specific details, There's no disclosure like that, just a general guidance. So can't comment on specific models and customers.
Okay, and sir, on this 550 crore cash balance which we have we decided or looked at any other inorganic opportunities? Are we pursuing any guidance you want to give on that front?
Yeah. So for our cash surplus, the preference is always utilizing it for M&A opportunities in powertrain agnostic products. But we don't keep any fixed timeline as we want to be very careful with the deal and the valuation specifically because we are on the conservative side. And we want to ensure that, it would create long-term wealth and value for the company as well as shareholders. We all often are having many talks, interactions, but nothing has materialized. There could be some possibilities, but as we know more, we'll keep you updated. And further to that, we've established a robust dividend policy. In fact, last financial year was the highest dividend we've ever declared by a significant margin. And we'll continue to return back, additional surpluses to shareholders via dividends and other options as they come. So that is on the cash balance.
Okay. Thank you so much.
Thank you. Thank you.
Thank you. The next question comes from the line of Sonal from Bowhead. Please go ahead.
Hi, Asim. Congratulations on good numbers. I have a couple of questions. First, on the employee cost seems to have moved quite significantly Q on Q. Can you throw some light on what is the reason for it and whether there's any one-off or this is a sustainable number? And then I'll ask you the remaining questions later.
Sure. Good evening. Good evening, and thank you. For employee cost, our increment cycle has started from the financial year. So I think the increment cycle has been adjusted to match the financial year. So that would have a quarter-to-quarter impact. In addition to that, we are hiring in quite a decent way due to upcoming expansion. So I think across all departments, we've been hiring as we're expecting good growth and expansion plans coming with regulation shifts and as well as our foray into the international market.
So this includes hiring for your tractor, business possibilities, or, is that also a decent part of the reason why, there's a jump?
Yeah. So we're expecting a good growth and we are just, building the team across the domain, right? So for all the growth aspects, and one of them definitely is tractors as well. And there's RD, export expansion and so on. So we are building the team and strengthening it for the future expansion.
Secondly, the benefit of RD norms started accruing because there was no call last quarter, started happening to the company fully in Q4 itself, or was it largely in Q1? And how has been the experience so far?
Sure. So RD got implemented from this quarter. There has been a gradual ramp up and we've established new lines for some of the products. In general, there's been some benefit in Q1, but of course there are things like the startup cost and the products maturing. As the production lines mature through the year and next year, there will be further improvement that we'll see from RD. And also for the new RD products, we are implementing the policy where we'll do the value addition part. We will not procure the catalyst so that there's full transparency. So we've applied that as well. And in general, I think we will see some benefit this financial year for sure from the RD norms kicking in.
So if I understood you correctly, very little benefit of RD norms is reflected in the numbers reported so far because of the startup cost and other costs, and some, cost related to that. Is my understanding correct?
Yeah, your understanding is correct. That it just started and new lines are there. So as they mature, the benefits will improve, and that's of course with the caveat that the overall business environment, passenger cars, LCVs, etc., continue to remain the same. But given that, definitely that we are expecting improvement as these lines mature. They just started this quarter, early this quarter.
This would be like what, Q3, Q4 or beyond that?
No, hopefully we will, if you look at it on a FY2024 basis, hopefully we will see some tailwinds that will come in from RD. And that could improve as we move forward. And we're already seeing some improvement and we expect it will keep improving as things mature.
Great. Two more questions with your permission. Firstly, on the expansion side, you mentioned that you have got aggressive expansion plans. So whatever is possible for you to tell us, whether it's international market or, new customers, or when you say expansion, are you referring broadly to the same customer, same models, or, it seemed from your language that you're talking about some aggressive expansion. So some light on that, considering,
Sure.
And then on the dividend policy, is there any specific dividend policy you mentioned about some dividend policy you announced, or you meant in general, you have been increasing dividend while there may not be any specific payout policy as of now?
Sure. So first I'll take the point on the expansion plan, and second I will come to the dividend policy. So talking about the expansion plan, number one, we want to maintain or increase our market share also in the LCV segment as well as the PV domestic exhaust. And with RD coming in, it's further become a good market, and we want to increase the market share here itself. Then our next goal is to attain market leadership in the domestic tractor market, which will become very, I would say, large as soon as TREM 5 kicks in. and we are working very hard with our teams across to ensure that we have a leadership position when it comes to market share in tractors. Then we are also built a vertical, which is nascent still, but people have been added for the export of subcomponents as well as emission systems for tractors, gensets on the smaller side, and that is our play on the China Plus One. And that is also that we are now preparing a little bit more to build one or two verticals which we already have internally or buy on the powertrain agnostic side. The vertical that we already do have is our suspension vertical, but it is not as mature as our emissions vertical, but we are adding people there as well as other possibilities on some adjacencies that we see in powertrain agnostic products. And this is largely on the expansion side. In terms of dividend policy, we do have a policy that is set out to have a payout ratio of between 10 to 30%, I think, and we would try to maintain on the higher side of the dividend policy as we go forward.
You have a very valuable piece of land which must have appreciated very significantly in the last 1-2 years, I mean, I hear crazy stories about land parcels in that part, in the last 6 months or in the last 1-2 years. Would you look at, unlocking value considering the extent of boom and the appreciation in the new land parcel you have, to shore up your cash for further future acquisitions, because the prices have really gone through the roof. And, first question is this.
Sure. So, we do have, two pieces of land in the NCR region which have been there, non-operational plant-free land for some time. And touchwood, the land prices have really gone up in that region. We don't have an estimate right now on what they are, but that is part of our, let's say, excess capacity for creating shareholder value. Of course, we're being maybe a bit conservative on the M&A front, but with the right opportunity and specifically at the right valuation, we would be more than happy to deploy that part also if required. And if, for some time we do not see, any attractive opportunity, then we would unconditionally unlock the value of the land at the right price and then have a plan on, giving back more to shareholders.
Thank you so much. My last question, any clarity on PLI policy and, if yes, then when you start seeing benefits of PLI? And what is your CapEx plan for this year as well as next year? Thank you.
Sure. So the PLI policy, a lot of changes in terms of how to calculate and guideline shifts that have happened. So we are working along with our internal team as well as an external consultant to, align to all the guidelines. It's still too early to say what the benefit of PLI will be. We are not considering any benefit as of now for PLI in our results, but of course anything that would come from that would likely to be additional. And when we look at the CapEx plan, we have a moderate CapEx plan for the year, but it could get enhanced a little bit in case we see the kickoff start for the off-highway industry. So we would be in approximately a range of 40, 45, 50 crores in case it is just a standard year, but in case off-highway market kicks in, as in, we call it a tooling kickoff, as if we receive, then there could be an additional 30 crores that goes into that 30, 35 crores.
And anything planned already for next year?
Similar, range that we are planning for next year also. And it would really be, and when the norms kick in, it would be linked to that. So it could either be next year or this year, but a very similar pattern as what we are planning.
What would be your cash and cash equivalents as on day 30th of June? Cash and cash equivalents as on 30th June?
I don't have the number. Maybe, I think Purusan, he's mentioned in the opening, maybe it's around 572 crores in cash and cash equivalents.
On 31st March or 30th June?
Purusan, if you could just see the exact number.
So, on 30th June, we have 572 crores.
Thank you so much. All the best.
Thank you. Thank you so much.
Thank you. A reminder to all participants that you may press star and 1 to ask a question. The next question comes from the line of Chirag Shah from White Pine. Please go ahead.
Yeah, thanks for the opportunity. Sir, I have quite a few questions actually. The first question is on the presentation side. Sir, can you indicate what is the volume growth? Can you indicate what is the volume growth on a consistent basis in your presentation, sir? Because it's very difficult to figure out how much is the volume growth for you and how much is the pricing growth, point one. So that is the first question. And also the presentation needs some changes because it's a very standard presentation without any additional information even on a quarterly basis. So if you can look into that side. So that is the first question on the volume side. If you can give us what was the volume growth for the quarter versus 4% revenue growth that you had.
Sure. So, thanks for the question. On the first part, before the part also, thanks for the feedback, and we'll definitely take that on the presentation and maybe, connect offline for more detailed feedback so that we can incorporate that into the quarterly presentation. Regarding volume growth, we don't per se disclose volume growth, but the way the movement happens in our mix as well as a component called the catalyst, in general, our volume growth has been higher than 4%, but it's just indicative on catalyst prices, etc. But it has definitely been on the double-digit side when it comes to volume growth.
So, sir, if you can make us understand what versus a 4% revenue growth and a double-digit volume growth, so how does the mix change for you? If you can make us understand, it would be helpful. Because you indicated that there could be certain changes in the mix which could have an impact on the volume growth.
Okay. So our products, are first cross-used across platforms, and they are also cross-used across industries, right? So our products are used in pass cars. The same product might be used in an LCV, and now we are seeing that the same product is now being used in minivans, as well as now it's going into off-highway, and it is an engine-based product. So it is a little bit difficult to curtail in terms of, or correlate, in terms of volume to the market, right? And we also have a component called the catalyst, which is mostly a pass-through kind of an item, which we buy for some of the customers, and for some we do not. And that kind of also distorts in terms of correlating with volumes. We've been working with our customers to either disclose the catalyst or to make it free of cost. So as positive moves towards it, we've reached an agreement with key customers to minimize the buying of this catalyst and go towards the FOC model so that it's more apple to apple. And all our new products which have come in this year or which will be coming in also are generally without this, so it will become clearer as we move forward. And that is probably the best way that we can look at for the time being. But volume standalone, that's something that we don't share.
So, sir, does it mean you are looking to go back to the earlier way of disclosures where your revenue, your margins will be significantly higher because the bought out goes out?
No, so earlier that was not the case. We have always been in the same way only. But earlier
I'm referring to the before the transition, we used to have a double-digit margin and half the revenue, right? And then the transition of emission norms happened where you had to increase the bought-out component to make it as an assembly, and where revenue doubled and your margins kind of half, in a very crude form. I'm just referring to.
Sure. So before the regulation change also, it used to be the same thing only. but at that time, the bought-out component, the catalyst, was much cheaper. So as a percentage of overall sales, it used to be much lesser, right? But it was the exact same way. In fact, previously, we were buying more of it, right? Because we didn't have agreements with all our customers, or at least more than half or even larger than that, we don't buy it for. So the change that you saw pre-regulation change and now is only that catalyst prices shot up, because what's required in BS6 is a much more expensive catalyst, and that's why it appears to be a higher part, and optically that's why our margins look at whatever 10-11%, but of course they're much higher if you remove that part out.
Okay. But sir, if you can indicate in the presentation what is the bought out component revenue and what is the normal revenue, and give the volumes, it would be helpful for us to understand how is the value curve moving in the existing product also. Otherwise, it becomes very difficult to understand your quarterly results.
Absolutely. And the point's well taken. And in general, we've tried to do that, but because of customer confidentiality, we've not been able to disclose in that pattern. Best is to look at our results more on a long-term basis, and there it correlates very well. And in general now, as a policy going forward, we are not taking many products with catalysts, right? And this, very shortly will be fully transparent as a result, because legacy products, our customers want us to continue with the model, but new models are being on a value-added sales basis, so then it will become clearer. But we are working on the same, and we will definitely go towards that.
So, second question was on the dividend policy that you had. In fact, the correlated question, sir, before that, I wanted to understand, when you are looking for M&A, one, what is the sweet spot of revenue that you are looking to acquire, and what are the capabilities that you are looking to acquire, either product capabilities or business capabilities, and the sweet spot that you have in your mind to acquire?
Yeah. So we have a range, right, and we don't have a disclosure on the range for it, but maybe to help you understand better, we want to utilize it for powertrain agnostic products, right? So we are really looking at products which do not shift with changes in powertrain, and also companies which either have a strong presence in India or are likely to have a strong presence in India as we move forward. And the range is something which is, without sharing numbers, which is big enough for it to be valuable to spend the management bandwidth as well in it, yet not too big as we are not very well versed with M&A yet, given that the company has never acquired a company before. And so we would, of course, want to start with a medium scale. But this is just a range-bound kind of look that we are having on M&A.
So why I'm asking is because your cash pile is just increasing given the business that you have and the trend that you have. So if you have a particular amount in mind, maybe 20% of your current revenue or something like that, the excess cash could be returned back in terms of buyback or dividend, right? So that because every year you are going to have a significant cash pile. You already have 20%, more than 20% of your market cap in terms of cash. So, no, and given our conservatism, I'm pretty sure that you are not going to go out and write a check of 1,000 crore or something like that, unless it's very, very, very lucrative kind of a thing.
Okay. So, without commenting on the number, as we said, there's no number as such in terms of what could an M&A look like, but the philosophy which you just mentioned is well recognized, right? I think there's no doubt that we recognize that this is a very significant cash built up, and we do need to have a more straightforward policy on it, and we also do need to cap it, and we also do need to, in case above a certain limit, return back to shareholders in the formations that you spoke about. So I think the philosophy we are completely aligned with, but don't want to, state an exact number or exact, kind of range also. But the direction is exactly what you mentioned that we are thinking in, and actions would also be made on that direction.
Thank you. The next question comes from the line of Karthik EN from Suyash Advisors. Please go ahead.
Yeah, hi, Ashim. Hope I'm audible.
Yeah, hi, you are.
Yeah, thanks. So first is, of course, I'm going to belabor the same point that Chirag made, which is I would appreciate if you can be slightly more proactive with communication, especially under exceptional circumstances. The break has been a longish one and there's been no communication. So if you can, consider that as an input, that will be helpful. The second, of course, is a long pending request for some kind of an index for volumes. The sooner you do, the better. Otherwise, your presentation is like reading the same novel a third time. There's nothing really in terms of details in the results. So kindly think about that. The PPT can be slightly more self-explanatory. Otherwise, the table is anyway shared with the exchanges. Just by way of feedback, it helps because I think the value here is too great for people not to be left in the dark for so long. That's the point I'm making here.
Sure, point well taken, and the feedback well taken.
Yeah. So first question, one is, can you talk in terms of what specifically is the letter and spirit of this change that you have communicated with reference to the JV?
This is regarding the ETPL JV, right?
I'm talking about the Everspark joint venture.
Okay. Yeah. So the JV scope is only amended for simplification. So the language has been changed on the scope of the JV, making it engine focused now rather than category focused. As mentioned before, that OEMs have started using the same engine in commercial vehicle, gensets, construction equipment, tractors. So it's very tough to now bifurcate in terms of category or segments. So we thought it's much better to do it in terms of engine, right? So because then there is no gray area. And this will become very important. Now we wanted to be proactive about it because as we know that the construction equipment market in India is becoming emissionized. Gensets will require products, tractors will require. And then it was very important not to have any kind of ambiguity there. And we are also approaching international markets. So we wanted to be clear on the scope side of it. So it's simply to make the language simpler and crystal clear in terms of engines.
So just to clarify, when you say that it is engine focus versus category focus, does that mean that they would also be addressing some of the categories that you were earlier addressing as the parent company? How should one think about that? Or do you still say anything about 3 liters they will do and anything below 3 liters will do, irrespective of category? Is that a way to understand?
Yeah, so it is, the literage might not be exactly 3, it's higher than that. But but the way to look at it would be that it would basically be status quo as of now, right? But all the changes that are coming into the market where products will be required and off-highway and cross-usage and on, there'll be no overlap, right? So our addressable market remains the same. It becomes slightly larger. And there was one category probably which we could not have addressed before, which is a niche category of higher engines in the segment of gensets, marine and things like that, where we didn't have the technology. But now with the simplification, if the opportunity presents itself, then we can also utilize that technology for those kind of applications also.
So the parent entity, or rather the listed entity, can use the technology to address that opportunity?
No, that will go into the JV. In case very, very large kind of engines and all, it's like a very niche technology which we don't have. A JV partner has. So from looking at it as a standalone entity, there is virtually no change apart from just making it engine focused and also clearing out any ambiguity for the emission changes that will be coming domestically, and also giving a clean slate for looking at international opportunities via exports.
And the chairman and the CEO to be appointed, is that a time-bound thing, or, how exactly would that be? Appointment by Ebbers Parker on the JV?
Yeah, so I think all other terms are exactly the same. That management control remains with them, and that's why we don't consolidate the sale. Everything else remains the same. It was a very simple thing to the scope only, which I just mentioned. Nothing else has changed in the JV agreement.
Sure. And while we are on the topic, can you just update on the performance of the joint venture? Has there been any improvement in the volumes at all?
Yeah, so this quarter, in fact, has been very slow. And I think in general, the CV industry we've seen has been slow. And even when we look at it on a Q1Q basis, Q1 is a slow quarter for CV, but even on Q1Q, I think the industry has not done very well. So the sales have not been great for the quarter, but nevertheless, we still remain profitable. And our capacity utilization remains to be around 50%. We have taken the initiative to make some of the products to be cross-used across engines, right? And that would become important maybe a year later, because then whenever the opportunity presents itself, it would be slightly faster. And we are working, with the customers to increase share of business and get into some of the high runner products. But goal was to stabilize. That's what we have been able to stabilize the GV quite well, and that's indicative that even in a low volume quarter, we remain to be profitable. But of course, a lot of work has to be done in terms of increasing market share.
You would want to give us some kind of a timeline for when we can see meaningful upsides?
I mean, it's totally dependent on the CV industry and also the customers' preferences, on how they're going to move. So it's very difficult to give any timeline on this kind of thing. And CV in general is very concentrated, the volumes, on just a couple of engines, right? So the market share shift, when it happens, it won't be incremental, it'll be dramatic, right? So if we were to even get one engine, we could see a substantial increase, right? But of course, given that it's so concentrated in engines, the competition also defends it as eagerly. So we are in that and we are working towards that. But tough to give a timeline, given that there are only, I think, 3-4 engines in the entire market that are really out there, right, when you look at it from a value perspective.
Fair. On the parent entity, I refer to listed entity, can you give, one question would be on the sourcing part. So, in what time frame do you believe the old models would have completely, been phased out and business would be entirely based on the newer model? I'm just trying to understand, in what time frame would manufacturing be 100% of your revenues, reported revenues?
There's no time frame because we don't know when models, would exactly expire. And either way, it has absolutely no impact on EBITDA, on profitability, and overall performance and numbers. It's only the optical change that would happen, and that's it, right? So the only change that would happen is literally optical on the sales number, and then it would be correlated. But in terms of...
But there was some benefit of cash flows is what I understood. Would that be correct or no?
No, there's no benefit as such on cash flow side also, right? Because it's neutral, right? And that working capital anyway shifts here and there, based on other things also. But regarding this change, the change will largely be optical in nature from the sales perspective. But the benefit is then it will be much more correlated, I guess, on basis to industry and all that. But still, I don't think quarterly it can be correlated, but definitely annually. It's something that will be much simpler to correlate.
Sure. And one quick question on the breakup of other income that would help. Okay. Substantial numbers this quarter.
Yeah, I don't have that offhand, but we will share it with you offline on the other income side. Noted, I will share that.
You're right. And then one last thing, and then I'll let you go. Can we meet sometime, please, just to engage you a bit more, in detail? That would be useful.
Sure. we'll definitely set something up and we will schedule.
That would be greatly appreciated. Thanks.
Definitely.
Yeah, thanks and best wishes. Thank you.
Thank you so much. Thank you.
Thank you. The next question comes from the line of Ankur from Quasar Capital. Please go ahead.
Yeah, hi sir. Thanks for taking my question. Sir, I was just trying to join the dots on your comments about volume growth. You mentioned that it was a double-digit volume growth, and considering the RDE norm setting in, where the minimum expectation of content per vehicle is going to go up by 10% or 25% depending on the engine which it applies to. So, sir, I'm not able to join the dots on the revenue growth of 4%. Can you just help me understand that?
Sure. So, the RDE norms have just been implemented. There's a gradual ramp up in this quarter. New lines have been established, right? And as indicated before that the gasoline content per car is going to be a 10% increase. Diesel would be 20%. And then there are, of course, other parts of the business also that come into the sales number. So on a blended basis, we'll have a tailwind of roughly 10% plus for the overall years, given that everything else goes well. So that is the guidance when it comes to RD.
No, so exactly the question, sir, that why didn't it happen during the quarter? During the quarter, you're saying that there are many cars which were still manufacturing without the new RDE norms?
No, so we actually supply in terms of engines, right? And the ramp up was gradual on this basis, right? And RD norms have an impact on mostly the hot end of the car. We also manufacture the cold end of the car. We also manufacture other parts of the car. So it's more like a blended impact that we'll see. And I think more will come in Q2 onwards.
Okay. So then second question is, again, slightly linked to the cash generation and the business plan which you have. So considering that, we have been hearing from you about the M&A part, which you rightfully explained that, we want the right mix, and since it's the first time you don't want to go aggressive, that is understandable. But from a business perspective, why don't we, try and start something on our own and depend on M&A to go through? So you have the customer connects. We can just go and ask them that, what is the requirement, and we can do some R&D. I'm just thinking out loud from a business angle because, we have been waiting for this since a long time, and the cash is piling up, and it is going to pile up by 200 crores every year. So just your thoughts on this will be very helpful.
Sure. So first, we as a company have grown substantially in the last couple of years. And a lot of bandwidth got consumed in terms of where we are in the emissions industry also, right? So it was not a very easy task to take market leadership position in India for BS6 and now for BS6 RD. And then we have a few more emission legislation that are coming in. So we definitely wanted to focus on the core, right? When we're talking of the organic side of it. And then now that, maybe 1-2 emission norms are there, definitely a similar philosophy to what you're mentioning is what we are charting towards. But we are on the conservative front. We rather not do an M&A than do an M&A at an valuation that will not create wealth, right? And we just want to be careful on that front. And we have also very recently only come up with a dividend policy, right? And it would be on the higher side only that we would move forward on, which would ensure that, there is a good return also coming back to shareholders and not a very excessive pile up in terms of cash earnings. But point well taken, and the philosophy is exactly what you mentioned on the organic side as well as on the inorganic.
Sure, sir. And so last question, just a follow-up because there was no follow-up announcement on the rates. So is that matter settled or there is some litigation which is pending with regards to that?
So it is, as per what was disclosed, that it was a search and survey, right? Business operations are continuing as per normal. And there is no update beyond that. And it's just, these kind of matters are routine and they take time. So there's no litigation per se.
Okay, thank you, sir. All the best.
Thank you. Thank you so much.
Thank you. The next question comes from the line of Nirvana Laha, an individual investor. Please go ahead.
Yeah, thanks for the opportunity. Hi, Ashim. Nice to speak to you after a quarter's gap. A couple of feedback points also from my side. One was echoing the same thing that the last gentleman said about a meeting request. So we've been reaching out to your IR quite a number of times. So if you can probably, give us some time to maybe multiple shareholders to meet face to face, that would be really nice.
Sure, absolutely. Point well taken. And, we're fully consumed with this RD implementation personally. But now that RD products are implemented, I will definitely take the time out and to meet in person.
Sure, we'll look forward to that. Another thing is, often when financial questions are asked on the call, for example, the other income question that the gentleman asked, we don't seem to be ready with the answers. But Ashim, to be honest, these are standard questions where shareholders only get a once-in-a-quarter opportunity to clarify them. So since Mr. CFO is also on the call, I would request you, if possible, from the next quarter to be ready with the numbers so that, these are the inputs that we can get during the year. Otherwise, we have to wait for the annual report, right? So if you can please take that suggestion on board.
Sure, absolutely. To the best, of our ability, we'll try to be ready. And unconditionally, you can always reach out to the IR advisors for specific points.
Sure. Okay, thank you. So coming to the question, so there was a 330 crore increase in other financial assets during H2, during the second half of the financial year. Could you comment on what this was exactly? What were the assets?
I think this would be part of the overall investments in cash surplus, but maybe Purusan, if you're aware of this number, is this just the reconfiguration of the cash investment?
So this detail is not handy. We would be happy to supply this information offline.
Okay. All right. The next question is on, in March, I think you commissioned a new plant for emission systems with a 5.25 lakh capacity. So two questions. What kind of capacity increase would this 5.25 lakh constitute? And towards what, purpose is this exactly? Is it targeted towards one particular segment of your emissions business, or is it generic?
Okay. So we have expanded capacity in the West for a couple of reasons. One, we did some existing, space for RD. Then we are expecting a few of our customers who will be adding capacity as well in the Western region. So that's in the news. So we are preparing for that. And as well as some TREM 4 kicked in, as well as TREM 5 will also be, West region will be a pivotal part of it. So we'll be utilizing this capacity over the next couple of years.
Okay, and as a percentage of your existing capacity before this came online, what percentage increase would this be, roughly?
Yeah, so we continue to augment our capacity because it gets augmented fairly easy on a capex light model. So I don't have the percentage number, but in general, whatever that you mentioned is the capacity we would have in cumulative products, right? So this is hot end as well as cold end.
Okay, all right. And on your Eversparker or the Purem JV, would you be able to tell us what the Q1 revenue was? And on a, suppose we get into one of the engine programs that you just mentioned while answering to somebody else, what kind of maximum revenue potential could we be looking at? Because, this we understand that COVID was there and there was a lot of disruption. And since then, it seems like you're ready with the product, but waiting with the OEM. So just for us to get a sense of how this could ramp up in terms of a number, what could be a potential yearly number if things work out favorably? Like, would it be as large as our LCV, or would it be much smaller than that? Some idea would be helpful.
Sure. So, in terms of revenue, we roughly in this quarter did between 80 to 90 crores, and that is including Catalyst. In terms of increase, it could be substantial. So you could imagine double or tripling in case we get one or two good engines. But nevertheless, it would not be as big as the standalone entity. I think we address a much larger market in the standalone entity. So for the time being, it would be significant, but not like anything that you can compare with the standalone entity.
Okay, so this 80 to 90, am I misremembering, or did this used to be 40 till about 2-3 quarters back, or was that without the...
I think that was without Catalyst, which we had mentioned. Okay. This is with Catalyst.
So without Catalyst, number would still be trending at the same 40 crore, 45 crore.
So on a Q-on-Q basis, it is roughly the same. I think there's been a decline of 5-7% on a Q-on-Q if we look at the quarter-on-quarter results. But it would be the same number, very similar number.
Okay, got it. On TREM 5, any more visibility? Is April 2025 looking the likely timeline? Any update from either from the government or what you're picking up from the tractor industry?
So the tractor industry is preparing fully for it. There is some delay expected. It was originally, I think, planned for April 2024, but if we look at the trend that we saw in TREM 4, there is some delay expected, but not too much. There's been no formal notification of it, but preparation by all the tractor makers is on full swing, and prototype development, testing, etc. is happening as per normal. But it's up to, when the notification comes. So some delay could be expected.
Okay, all right. And final question on the your battery JV. So what is happening here? So the last time that I asked you this question, you explained how this was more going to be a BMS assembly, a low value add initially, where you would be learning first, understanding the ecosystem, also changing regulatory needs, etc. You explained the whole go slow approach. So have we seen any revenues from this JV in the last quarter and this quarter? And where are we right now? Has our thinking changed at all on this? Are we speeding up, or how is it going?
Yeah. So the last time when we spoke, we are largely same in terms of the philosophy that we will be very cautious and we'll go slow. What the updates probably are that we have built up prototypes, and the first phase of testing has been completed for them, and we are applying with the agencies for approval, which is required on the battery side, and this is again battery assembly side. We of course want to be 100% sure of these products, because there's a very high field quality risk that batteries, especially in this segment, have, as well as warranty and servicing. So being very careful. And of course, the subsidies have been reduced. That has increased the cost pressure quite substantially in the market. So we are making some changes in the configuration to be more competitive on the cost side. And also these AIS amendments also which came in, while the batteries are compliant to it, they have become more expensive. So we are reconfiguring that. In terms of revenues, there is no substantial revenue from this. And we don't project. We will be going very cautious and slowly in this segment.
Right. So your presentation still says that the plant is under consideration. So what I would like to understand is what milestones do you have to hit for the plant to be sort of a green lit? That would be helpful to understand.
Sure. So the batteries, prototypes to be approved by the agencies and to be within the cost target range of the customers.
Okay. All right. All right. Thanks, Hashim. I wish you all the best.
Thank you. Thank you.
Thank you. Due to time constraints, that was the last question. I would now like to hand the conference over to Mr. Puru Agrawal for closing comments.
We thank you for your participation in our earnings call today. We hope we have been able to address all your queries. However, If you have any other further questions, you can get in touch with our IR advisors, Strategic Growth Advisors. Thank you and have a good evening.
On behalf of Sharda Motors